Welcome to this explainer. Today, we're cutting right through all that daily market noise to look at the ultimate, step-by-step roadmap for structural investing. So whether you're just refining your long-term strategy or you're looking to really stress test your current portfolio, let's lock in those fundamentals.
Okay, let's dive straight in by asking what is arguably the most crucial question right up front. When we think about catastrophic market mistakes, our human psychology naturally jumps to active errors, right? We picture buying the completely wrong stock, mistiming some massive trade, or trusting a terrible tip that just wipes us out. We are totally wired to fear sudden, noticeable losses. But according to the experts at National Bank Direct Brokerage, the single biggest error in finance is actually far more passive, and unfortunately, way more common. The reality is, the biggest mistake is simply not investing at all. Look, staying on the sidelines might feel like a safe harbor, but it's an illusion. By doing nothing, you're actively letting inflation silently erode your hard-earned money. You can really think of inflation as an invisible tax. If your money is just sitting there in a low-yield checking account, it is relentlessly losing its purchasing power every single year. The cost of living ticks up, but your savings stays stubbornly flat. So the absolute only way to outpace that invisible tax is to put your money to work.
To help you do just that, here's our roadmap for today. We'll cover the power of starting, finding your risk balance, asset allocation and diversification, smart investment tools, and finally, avoiding common investing traps.
Step 1. The power of starting and the absolute magic of compound interest.
Let's look at a really simple example. Take a principal amount of just 10,000 rupees. If you lock that in at a modest 5% annual return and literally walk away for 30 years, it balloons to over 43,000 rupees. You haven't added a single extra penny of your own capital. The growth happens completely autonomously because your interest is earning its own interest, creating this massive snowball effect over time. It's the ultimate shift in mindset. You move from working for your money to having your money work relentlessly for you, even while you sleep.
The difference here really comes down to linear versus exponential growth. Simple interest is strictly linear. You only ever earn returns on your original 10,000, leaving you with 25,000 after 3 decades. But compound interest, that calculates returns on both the principal and the continuously accumulated gains, driving that total up to 43,219. This exponential growth curve is exactly why compound interest is famously called the eighth wonder of the world. It mathematically proves that in finance, time in the market is exponentially more valuable than trying to time the market.
Step 2. Finding your risk balance and understanding your tolerance. So, there is an unbreakable rule in investing. There's no such thing as high reward without high risk. And the psychology of this is super fascinating. It is incredibly easy to aim for a higher 7% average return when times are good, but pursuing that growth means you absolutely must be comfortable weathering a potential 30% drop in a single year. If watching a third of your net worth just vanish on paper would make you panic and sell everything, then that aggressive approach simply isn't for you. You might need a more conservative strategy that offers a smoother ride, even if it costs you a bit of long-term growth. Finding this unique psychological balance for yourself is mandatory before you buy a single asset.
Step 3. Asset allocation and diversification, or how you actually steer your portfolio.
Building a resilient portfolio isn't just about throwing money at trending stocks and hoping for the best. Not at all. It requires a strict 3-part framework, a solid plan tailored to your specific timeline, careful investment selection, and a robust strategy to protect those assets during the inevitable market volatility. Basically, you're building a structural fortress around your wealth.
Now, people constantly confuse these two vital concepts. Asset allocation is your macro strategy. It's choosing the broad categories of assets you want to own, like stocks versus bonds. Diversification, on the other hand, is your micro strategy. It's spreading your dollars around within those specific categories so that a single company's failure doesn't wipe you out entirely. So think of it like this. Allocation sets the destination for your road trip, and diversification ensures you don't blow a tire on the way there.
We can use the rule of 3 to break down your asset allocation into the core classes. First, you've got stocks, or equities, for your long-term growth, knowing full well they'll be a bumpy ride. Second, you use bonds to generate steady income. They act as a really vital shock absorber for your stocks during a crash. And third, you use money market, or cash equivalents, for short-term safety and immediate liquidity. By just adjusting the dials on these 3 categories, you build a customized portfolio that perfectly matches that risk profile we talked about earlier.
Okay, get ready, because here is a landmark finding that shocks seasoned and new investors alike. A staggering 91.5% of your portfolio's long-term performance is determined simply by your asset allocation.
Think about that for a second. The broad mix of stocks, bonds, and cash you choose completely dwarfs the impact of individual stock picking, which accounts for less than 5%, and market timing, which is under 2%. The takeaway here is incredibly liberating. You can stop stressing over finding the perfect stock and focus almost entirely on getting your high-level asset allocation right.
Step 4. Smart investment tools. Let's look at the actual vehicles for your wealth.
Governments provide all these specialized, tax-advantaged accounts to intentionally encourage us to save. And honestly, they should always be your first priority. Whether it's a 401k, an IRA, an HSA, a 529 plan, or utilizing trust or ABLE accounts, these vehicles all do something absolutely crucial. They shield your money from the constant drag of taxes. Every single dollar you don't pay in taxes is another dollar that stays right there in your account, compounding. This lets that compound interest engine we talked about run at absolute maximum efficiency.
But inside those tax-advantaged accounts, you actually have to buy something, right? And the index fund has completely revolutionized modern investing. Instead of trying to guess which individual company is going to win, an index fund simply buys a tiny piece of every single company in a benchmark. It is incredibly low maintenance. It instantly diversifies your risk across hundreds of companies. It keeps your management costs super low, and it essentially guarantees that you're going to perfectly capture the general growth of the market, all without breaking a sweat.
Step 5. Avoiding common investing traps and protecting your progress.
Let's rapidly step through the psychological traps that can break even the best strategies. First up, the cash cushion. Look, if you invest your rent money, a sudden market dip is going to force you to liquidate and sell at a loss just to survive. Don't put money in the market you need next month. Second, muting the noise. You have to actively ignore impulsive decisions driven by scary headlines or euphoric rallies. Third, rely on objective research, not social media hype or your brother-in-law's trendy stock tip. And finally, never ever abandon the risk tolerance you set back in step 2 just because you see someone else getting rich quickly.
Always remember this: what goes down inevitably goes back up. When the market drops, and trust me, it will, it feels utterly terrifying. Every instinct is telling you to flee. But historically, markets go up far more often, and to a much higher magnitude, than they drop. Sticking to your long-term, diversified strategy is literally the only reliable way to weather the storms and capture the eventual, inevitable recovery. Patience isn't just a virtue here, it is a strict financial necessity.
To wrap up this explainer, I want to leave you with a somewhat provocative truth. We've seen the math today. Compounding is the undisputed engine of wealth, and every single year you wait costs you exponentially. You now have the roadmap, you have the tools, and you know exactly which traps to avoid. So what specific step will you take today to actually start your journey? Thanks so much for joining me, and I'll see you in the next explainer.